right, everybody. I wanted to go over a new stock purchase that I bought, and I'm focusing on the cash flow for it. This is a high dividend yield play. It does have a little bit of dividend growth. I'm not looking for much in the capital gains or capital appreciation, but be very happy with the dividend, as we'll see. Stock is called NEWT. I put this on my Seeking Alpha page under my portfolio. It is now on here. 21.37 is the current share price. I actually bought it earlier today on February 18th, and I bought it for 21.15. So I'm already up a little bit of money from it. Notice in the analysis says it's an investment bank rather than a BDC. A BDC is called a business development company, and the only one I own is Main Street Capital, which has been doing very well for me. Notice that the yield is really high, 10.37%. So in a business development company, you could Google BDC, and then you'll see a bit on Investopedia about it. Essentially, they will give out loans. They invest in small and medium-sized companies, as well as distressed companies, a lot like Shark Tank or The Profit. There's a show on CNBC where they buy distressed properties or they buy equity in them. Back in 1980, the U.S. Congress made this as a possibility. They make investments publicly traded, high dividend yields, because to qualify as one, they must invest at least 70% of the assets in public firms with market values of less than 250 million, so pretty small companies. They also are required, just like a REIT, to give 90%. They must distribute 90% of their profits to shareholders, meaning that most of the money that they get in from the loans and equity that they obtain from other businesses by giving money to those companies, they have to give back over 90% to shareholders. Just like REITs, real estate investment trusts, they have to give 90% back. Now, out of the profits that they make, they could decide to make more loans out, or they could decide to, for a REIT, for instance, buy more properties. So your dividend yield will not always be exactly 90% of what you're getting, but a lot of that could be reinvested to make a bigger portfolio as well. They don't pay income tax on profits because they distribute them directly to shareholders. Because of this, your dividend yields are very high. Income receiving them will be at their tax rate for ordinary income. However, if you put it in a Roth IRA account, you do not have to pay the ordinary income tax, which makes it pretty dramatically better than in a taxable account. Because even in a taxable account, your ordinary income tax will usually be higher than the capital gains tax on a dividend. Okay. There is a bit of risk, so I wouldn't necessarily just go into any BDC that you find. So I've been researching quite a bit on many of them, and I'll tell you why I decided on NEWT. They are sensitive to interest rate spikes because they're giving out loans, so if the interest rates change, the value of those bonds or loans will not be worth as much. Untransparent holdings is a bit tricky. Some companies are better than others. I recommend ones that are internally managed, and Main Street Capital and NEWT is two that are internally managed, meaning that they have their management team working for their shareholders, getting as much profits back to the shareholders as possible. A lot of the BDCs are externally managed, meaning they have outside sources doing this, which also hurts with much higher fees in many cases. Okay. Some of them do employ leverage, so they borrow, and then they essentially go to a 2-to-1 ratio. It used to be 1-to-1, but now President Trump recently, in the new tax law, made it 2-to-1 example. So this is the back test of NEWT. If you go to Portfolio Visualizer, you can put in a certain amount of money, certain year, and you can put whatever stocks you want. If I put NEWT 100% into it, click Analyze. From 2010 to now, if you started with $10,000, the final balance was $82,325. That's a very good increase. The CAGR is a compound adjusted growth rate, 23.25%, which is very high. Most companies will be in the 5 to 10% range there. Big standard deviation, so you're going to see big swings in this. The best year was 75% in 1 year. The worst year was pretty low, 33% down. And the max drawdown from the high to the low at a certain point was 38%. So I'm not going to be putting a ton of money into this company. It will be a small percent of my portfolio that I'm going to plan on increasing in the next few months. Portfolio growth, very steady increases. Even with the max drawdown, you see these little dips here. The dividend yield at being almost 10% is so high that it helps negate a lot of bad years. 2011 was obviously a very bad year for them, but they've been having a very good run. If you look at the current stock price at 21.37, the last month actually decreased a little bit. We're at 21.92. If you go a little bit later, even as close as November, it was at 23.85. So it went down almost 15% in stock price from, again, almost December to now. So only a few months, it actually went down quite a bit. The reason why is certain companies are worried that they may not continue the growth rate that they're having. So I think that this is a good opportunity to buy low if you're interested in a very high dividend yield. Here's some of the basics from their investor relations. 5-year total return, 200%, while S&P is only 68%. 3-year return, good. 1-year return, pretty solid as well. Business purpose. They loan out money to small and medium companies, but they also have quite a bit of additional revenue sources that most BDCs don't have. So if you go to NEWT business, NEWT, not news. Is a different one. They have a wide range of solutions for these businesses to increase their productivity as well. So not only do they do financing, pretty high transaction volume. Oh, they want to try me right now. Payroll, HR, employee benefits. They give insurance for businesses. They have data centers, quite a bit of assets. So the different solutions that they have are loans, payments if they need to collect payments from other companies like Visa, MasterCard, and stuff. Payroll benefits for their companies, web solutions, even give insurance, and they have servers for technology. So very wide-ranging BDC. Not only do they want to give out loans to companies that might need additional income that might be too big for the banks, but they also want to provide these additional solutions to increase their revenue streams. So they offer financial business services, one of the secrets to success, and they have a lot of partners that they work with. They want to drive traffic to their other pages as they give out loans, business, payment, technology, payroll, and insurance. The financial highlights, they've increased 29.4% of investment income from last year, 62.5% improvement in net investment income. BDCs with market cap below 500 trade at 0.85. It does trade a little bit higher than that, and the yield is actually a little bit lower, but they are offering these other things to help out other companies. I'm going to go over the dividends. Going to get a lot of this is a little beyond my scope of understanding. I want to talk about the financials, but third quarter cash dividend 58 cents per share, exceeded by a penny. October 10th, 71 cents. The fourth quarter was in line with $2.15 per share. It shows a 19.4% increase over the dividend of 2018. That is a huge increase, especially for a business development company. They expect to stay within the 90% of income going back to shareholders, so they stay as a BDC. Forecast for this year, and every year they've not only met, but they've slightly increased their dividends that they provided to investors. They forecast $2.19 per share, which is about a 2% increase from last year. And if you look at the last 3 years, 2016, they predicted 1.5. They paid out 1.53. Next year, 1.57, paid 1.64. Year after, 1.69, paid 1.8. Next year, 1.84, paid 2.15. So they've been increasing the amount of dividends that they even forecast that they'll be giving. And they're forecasting a 10% dividend yield, which is already very high. And those are a few reasons why I think that this could be a very good company to own. I plan on taking my RYLD monthly income, adding additional monthly purchases that I have from my cash flow and from my jobs. I'm going to get probably close to around $3,000. If the stock rises very sharply, then I probably will slow down or look for other investments. But I plan on having Main Street Capital being the biggest BDC at about double that, and then this might be a second. And I'm looking at a few others just to have that high cash flow and high dividend yielding companies. If you have any questions on this, please let me know. Again, it's stock ticker symbols NEWT, and I'll talk to you guys next time.